In Lecture 7, we'll talk about valuation of corporations. This lecture is based on the second half of Chapter 7 in the Brigham and Eckert textbook. So in this lecture, we'll talk about the value of a corporation based on the free cash flow valuation model. First, let's review the two concepts that we talked about before, free cash flows and the VAC. Recall from our previous lessons that free cash flow is the amount of cash flow available for distribution to all of a company's investors, including debt holders and shareholders, and they are generated by a company's operations. The VAC, weighted average of cost of capital, is the overall rate of return required by all of the company's investors, including debt holders and shareholders. So in terms of the value of a corporation, where is the value coming from? We say a company owns two types of assets. First, we have operating assets. Operating assets are long-lived assets that are used in normal business operations. They are essential to the success of most companies, most businesses. There are three major categories of operating assets. We have fixed assets, which include the property, plant, and equipment, or say the PPEs. And then we have natural resources, such as timber, fossil fuels, and mineral deposits. And then we have intangible assets, such as patents, copyrights, and trademarks. These operating assets, they generate free cash flows. So the value of operations, or say the value of these operating assets, is based on the expected future free cash flows that they generate, discounted at the VAC. So for example, if we look at a piece of equipment that the company owns, and the company just spent $1 million to buy this equipment, but the actual value of this equipment to the company is not the $1 million, is not the $1 million book value of this fixed assets. It actually depends on how much free cash flow the company can generate using this piece of equipment. In other words, the value of operations, or say the value of operating assets, is not the same as the book value of these assets in the balance sheet. A company would also have non-operating assets. These non-operating assets include marketable securities and ownership of non-controlling interest in another company. They are not essential to the ongoing operations of the business, but may still generate income or provide a return on investment. Companies hold these non-operating assets for several reasons. It could be an asset related to a closed portion of the business and might be sold in the future. Non-operating assets can also be used to diversify operational risks or simply used as a cash investment to maintain liquidity. Value of these non-operating assets usually is very close to the amount of these non-operating assets reported on the balance sheet. So this is different from the value of operating assets. We say for the value of operations, it is the total present value of expected free cash flows discounted at the VAC. If we look at the formula, if we have a given year T, for example, T could be 5 for the 5th year, T could be 10 for the 10th year. So the free cash flow of that year divided by 1 plus VAC at the power of T, this is the present value of the free cash flow to be generated at that year. And then if we look at all the years, so we have T from 1 to infinity, we calculate all the present values of all those future cash flows, and we sum them up, we get the total amount, and that is the value of a company's operations. If we look at the value of the whole company, the blue chart here shows us the total value of the company, or say the total corporate value, consists of the value of operations and the value of non-operating assets. On the pie chart on the right hand side, the total corporate value belongs to all investors. So we see that this is how different investors divide the pie. Debt holders would have the first claim, preferred stockholders next, and then the rest, or say any remaining value, belongs to shareholders, or say equity holders. Now let's use an example to estimate the value of the company based on the following information. If we have the current free cash flow, or say free cash flow at year 0 as 24 million, WACC is given as 11%, and we assume that the free cash flow is growing at a constant rate of 5% indefinitely, and the amount of marketable securities is 100 million, amount of debt is 200 million, and the company also had 50 million preferred stocks, and the company has 10 million shares of common stocks. We can use this formula to estimate the value of operations based on this constant growth formula. So if free cash flows are expected to grow at a constant rate of G, then the value of operations equals to the free cash flow at year 1 divided by WACC minus G. And free cash flow of year 1 is calculated as free cash flow at year 0 multiplied by 1 plus G. So we have 24 million growing at 5%, so multiplied by 1 plus 5%, and then divided by 11% minus 5%, we have the value of operations as 420. Notice that this looks very similar to the constant dividend growth model for stock valuation that we introduced in previous lecture. Remember, for the stock valuation, value of the stock equals to D1 divided by RS minus G, right? So instead of have D1, now we have free cash flow 1. Instead of I minus G, or say the required rate of return minus G, now we have WACC minus G. When we have value of operations as 420, adding to the amount of short-term investment, or say the marketable securities, or say the amount of non-operating assets, 100 million, then the value of the total company is 520. Now this 520 belongs to all investors. So among them, debt holders would have 200 million, preferred stockholders would have 50 million, and here we assume that the market value of debt and preferred stocks are the same as the book values from the balance sheet. So subtract these from 520, the rest is the value of common equity, and that is 270 million in this case. We can then estimate the intrinsic stock price per share. Remember from the last slide, total value of common equity is 270, and then there are 10 million of shares. So 270 divided by 10, then for each stock, the intrinsic value is 27. Remember when we talk about stock valuation based on the discounted dividend, we introduced a two-stage approach to calculate stock price when the dividend growth rates are not constant all the time. Here, similarly, to deal with the non-constant growth problems, we use a same two-step approach. So for example, if we have the following projected free cash flows, year 1 we have a negative 10 million, year 2 we have a 20 million, and year 3 we have a 35 million. And apparently, if we look at these 3 years, there's no constant growth in the free cash flows. But then after year 3, we do assume that the free cash flows grow at a constant rate of 5%. We also assume that the WACC and amount of marketable securities, amount of debt, and amount of preferred stocks, or the number of shares of common stocks are the same as in our previous example. So in this two-step approach, step 1 is to estimate the horizon value. Since growth in free cash flows is not constant during the whole time, we can use the constant growth formula to find the value of operations at time 0. However, free cash flows is assumed to grow at a constant rate after 3 years. So in this case, the forecast horizon is 3 years. We can apply the constant growth formula to find the horizon value which is the value of all free cash flows beyond the horizon, or say after year 3, discounted back to the horizon, or say discounted back to the end of year 3 in this case. What we do is we look at the constant growth model and we try to estimate the value of operations at time t, or say time 3 in this case. That is the free cash flow amount in year 3 multiplied by 1 plus g, because free cash flows are assumed to grow at a constant rate of g after year 3, and then divided by back minus g. So 35 multiplied by 1 plus 5%, and then divided by 11% minus 5%, and we get a horizon value of 612.5 million. This horizon value is also called the terminal value or continuing value. Step 2 is to calculate the total present value. So after finding the horizon value, we consider all the free cash flows within the horizon, or say within the first 3 years, and we calculate the total present value of all of them at year 0. So we have year 1 free cash flow, year 2 free cash flow, year 3 free cash flow, and then we have the horizon value at the end of year 3. And the chart on the next slide illustrates the whole process of finding the value of operations based on these 2 steps introduced. As you see from this chart, after we estimate the horizon value based on the constant growth model, we try to calculate the present value of first year's free cash flow. So you see the negative 10 divided by 1 plus back at the power 1. Second year's free cash flow, so 25 divided by 1 plus back at the power of 2. And then year 3's 35 divided by 1 plus back at the power of 3. For the horizon value, because it is at the end of year 3, we also try to get the present value of it. So we have 612.5 divided by 1 plus back at the power of 3. Then we add up all these present value results. We got the total, and that is the value of operations at year 0, which is 480.67. After finding the value of operations, we can then calculate the value of equity and also the stock price per share, P0. So 480.67 value of operations, or say value of operating assets, plus the 100, that's the value of non-operating assets, which is the amount of short-term investment in this case. So we got a total of 580.67. Now this 580.67 is the total value of the company, and it belongs to all investors. And among them, debt holders get 200, preferred stockholders have 50, then the rest belong to common stockholders. So common stockholders have the so-called residual claim, which is the leftover of 330.67. That's the total amount that common stockholders would have. And that number divided by 10 million shares. Then for each share, each stock, the intrinsic stock price is 33.07. If you think, well, since we introduced the dividend growth model in the previous lecture, why do we have to talk about the free cash flow model in this lecture? That's because free cash flow can be applied in more situations. We can use it to estimate the value of a privately held company. We can use it to estimate the value of divisions of a company. And we can use it to estimate the value of public companies that pay 0 or very low dividends. So dividend growth model cannot be used in these companies or divisions because there will be no dividend data. But as long as they are operating and they generate free cash flows, we can apply the free cash flow model to estimate the value of these companies. And of course, to use the free cash flow model, we need to forecast a company's financial statement to estimate the free cash flows in the future.